Housing ratio. What is it and why is it important? Okay, your housing ratio is basically taking your debt that you have for housing, dividing it by your income to come up to show how much of your monthly income is spent on your housing. Okay, your housing debt is your mortgage, taxes, and insurance. Okay, and your income is going to be income before taxes and deductions, including things like overtime. It's calculated different ways. A lot of the time, it'll be using a combination of your most recent W-2s and pay stubs, though. Okay, and it's going to give you a percentage of how much you spend on your housing, and you want to stay under 25%. Now, the reason that this housing ratio is looked at by lenders is because it can kind of show us if you are setting yourself up to be house poor. And by house poor, I mean that your housing takes up a larger amount of your income than it should, enough that you don't have a lot of flexibility if something big came up. If there's something big came up and you had a lot of other debt or a lot of other expenses, and you may end up having a hard time paying those if your housing ratio is too high. Okay, and that's why it's important. Now, this is one that's, again, lower the better, but you can go up to 30%. There's not really like a hard and fast rule for how high it can be, but the lower the better. And most good, strong mortgage files that I've seen have been under 25. Most are somewhere in that 15 to 25 range. Okay. Not that you can't get one with higher. It's just 25 is a really strong 25% is a strong number for it. So yeah, that's your housing ratio and why it matters.